Okay, we're working chapter 14 related questions, and now we come to number 13. And 13 says Benjamin, who files as a single taxpayer, has $359,900 of taxable income in 2021. Compute his regular tax liability. So again, I mentioned we're not going to deal a lot with alternative minimum tax. We may look at it here or there, but no, as you get up into higher income, that's when that's likely going to come into play. But we're just talking about regular tax. So let's go over here, look at our textbook. One thing I was going to point out, so we're still into chapter 14 here. If you go, pull up my contents here. If you come here to the appendix or go to the very back of your book, you notice Appendix C is going to be the income tax rates. Already notice A and B are your present values, so those are useful. But if we go to the Appendix C, this is the same information that's in those pages of the chapter. Right, this one's going to be a little different though, because we're not going to use the married filing jointly, we're going to use the single table. So you notice his income, I already forgot it, $359,900. So it comes in a single and it fits down here in the over $209,450, but not over $523,600. So our formula is going to start with $47,843. Let's start that here. $47,843. And then we're going to add to that 35% of excess over 209,425. So 209,425. Right, so we're going to take the 359,900, subtract that, I guess we put that in brackets, multiplied, and I want to say, once again, we're in the 35% tax bracket. So that amount multiplied by 35%. And that would close the bracket. So 47,843 plus the difference between $359,900 and $209,425 multiplied by 35%. So let's pull up our calculator. And 359,900 minus 209,425 multiplied by 35%. We're going to add to that 47,843. Right, so we come up with $100,509.25. So again, if we only use the whole dollars, that's $100,509. Okay, so I'll get you started here on number 14. 14, Mrs. Kilo is an unmarried individual. She has $219,344 of taxable income in 2021. Compute Mrs. Kilo's regular tax liability if she files as single and if she files as a surviving spouse. So it's really going to give you practice seeing the difference between the two. So I'm going to run through the same thing we've been doing here, except I'm going to be using first the single table, and then for the last one I'm going to be using the surviving spouse or married filing jointly table. So I'm going to let you work through those calculations, so pause now and work through those, and then I'll let you know the solution here. Okay, and the solution here is actually none of the above. So if single, I came up with $51,315. If surviving spouse, or another way to look at it, if we used the married filing jointly tables, I came up with $40,684. Right, but what they wanted us to see here is filing status does make a difference. Right, in fact, we could pull up our calculator here. And it's a $10,631 difference. Right, but they would say if you're married filing jointly, you probably have more things to cover. And that's why there's those differences. I'm not saying everybody would believe that, but that would likely be the argument. Okay, and then here we look at one that kind of walks us through the whole process here. So Mr. and Mrs. Daniels, age 45 and 42, notice we're not going to be dealing with old age, had the following income items in 2021, and old age meaning no addition to their standard deduction, and it doesn't mention anything about being legally blind. So they had salaries and wages of $122,500. They had interest income of $6,300. They had dividends eligible for a 15% rate of $4,000 and capital gain eligible for 15% of $1,900. Right, so it says Mr. and Mrs. Daniels have no dependents and claim the standard deduction. Compute their income tax liability on a joint return. Right, so the first thing we need to look at is going to be our total income. Let's come here. Somehow it's going to let me figure total income. So total income is going to be the 122,500 plus the 6,300. I know they mentioned these rates. That's going to make a difference when we calculate the tax. But for total income, you just keep adding those in. So it's all of those things added together. The 122,500 plus the 6,300 plus the 4,000 plus the 1,900. So if we want to walk through that together. $134,700. So that's going to be my total income. Well, that's total income. So now remember, we looked, were there any kind of above the line adjustments? Right? We didn't mention anything about an adjustment. So that's going to be also my AGI. My adjusted gross income is going to be 134,700. So then that's when we compare the standard deduction to the itemized deduction total. So you notice their itemized deduction total, well, it even says they didn't bother with that, right? They're going to use the standard deduction. So let's come over here. Probably need to go back into my chapter. Let's come back up here to chapter 14. So standard deduction for a joint return, married filing jointly, is going to be $25,100. Right, so that's what we're going to need to come over here. That's going to $25,100. So that means taxable income is going to be the difference between those, which is about what? 100, well, we have a calculator. We'll work through it together. We subtract 25,100, so that's 109,600. So that's my taxable income. Okay, so this is where it comes in. So we get taxable income, and now we need to, how do I say this? Pull out the favorable amounts. For some reason it's not wanting to let me write. Pull out my favorable amounts. By that I mean, you know, the 15% rate is going to be charged for the $4,000 and then 1,900 for the capital gain. So $5,900 of it is going to be taxed at a preferential rate. So, and the system's doing this all behind the scenes. So a lot of times you don't necessarily see it, but I think it's good for us to break it out. So that means my ordinary income, and we'll put preferred income, meaning as far as tax. So we know that's going to be the 5,900 times 15%. That's going to give us an amount. So let's come back up here. Take the 109,600, subtract 5,900 from it, and that's 103,700. Right, that's what I'm going to use for my tax table. Let's go ahead and work through this 5,900 calculation since it's right here in front of us. That's going to be $885. And then for the $103,700, right, I'm going to come over here to my book. Go back to my tax table. And they're married filing jointly. Right, so it's going to fall into this category here. Over 81,050, but not over 172,750. So my formula is going to start out with 9,328. So again, we're working on the ordinary part. Plus the difference between 103,700 and that base rate. Go ahead and let you know what we're going to be looking for here. The base rate, which was 81,050, and that's going to be multiplied by 22%. So 81,050, and then that's going to be at 22%. So let's see how we do here. So I would say 103,700 minus 81,050 multiplied by 22%. And I'm going to add that to 9,328. So the ordinary income part comes to $14,311. Right, so this is, I should have made more room up here. But this is the ordinary part, is 14,311. So we take the 14,311 and we add that 885 that we calculated being at the preferential rate. So total is going to be, hit the page too soon, $15,196. Right, so total tax, regular tax, is going to be $15,196. So again, that was because we started adding total. So to do the total, you don't back those out yet because it's part of total income, even the preferential items. We got our total income, then we did a comparison between the standard deduction of $25,100, and there was nothing to compare it to because they just elected to do standard. That's not unusual in these years. That left us with a taxable income of $109,600, and then that's where we back out the $4,000 of the dividends and the $1,900 of the capital gain. That dividend, if you ever hear anybody call it a qualified dividend, that's the 15% rate. So you can have some dividends that are taxed at the ordinary rate. 5,900 is the total, so we took that 5,900, we multiplied it by 15% and got $885. On the other side of it, we took the $5,900 out of the taxable income of $109,600, and that left us with ordinary or income to be taxed at ordinary rates of $103,700. So using the formula, it started out with 9,328. Make sure we're in the married filing jointly, and we add the 22% of the amount. The $103,700 was over the $81,050 level we were in. The ordinary part comes out to $14,311. That $885 preferential rate. So total tax, you add those together, is $15,196.